Morning and welcome to the ASIS Economist Board. I'm John Nelson. I'm here with Keith Prater of Armada. I'm with Morris Nelson and Associates, and in this round we're going to discuss, what's in the current economic environment. And those of you who've been paying attention, it's quite an economic environment, and we'll talk about how our industrial production models incorporate the data, what's going on in the real world. And we've mentioned this before. We use about 18 to 20 economic indices in every one of our models going back 20 years. In this video for IPMAN, and then in our 7 related subsectors, we'll dig into what's driving each one of those models, and then we're going to put that into plain English, into explaining what that means in the real world. With that, Keith, are you ready to dive into this?
Yeah, see what we can do.
All right. So I'm going to start off with industrial production. Let me get myself on the right slide here. Hit share, where my little share thing went away. There we go. You got to get in the right screen. Okay, so industrial production for manufacturing, our kind of overall, take a look at it. And what jumps out at you right away is a lot of what the same stories was last month, and that is that you see the dip, and you see the dip starting pretty much right away. Keith and you and I were talking about it's about a 6% dip over the next few months from the current high. Putting it also in perspective, though, where it's landing at the end of 18 months is about the same spot that we were this past fall, around that September, October timeframe. So mathematically, what's causing it, we're taking what we're seeing is pressures from manufacturing inventories. We are seeing the tremendous volatility and the price hikes in oil. They're taking a toll on things, as well as the producer price index for manufacturing materials is all kind of weighing hard on this model and driving it to where, given that dip or swoon, you might want to call it, as you were saying earlier. Over to you.
Yeah, and this is interesting. I mean, because essentially what the models are saying is they're really starting to pick up that inflationary pressure, and that inflationary pressure is creating a really near-term, downward, push on the model itself. You and I were talking about the role of what a 6% drop, over the second half of this year would mean. And, right now with profit margins, looking pretty good. I mean, a lot of companies in Q1, I think when we look at the S&P 500, a lot of companies were reporting about a 10% average gross margin, which is still pretty strong. But when we start talking about top line drops of 6% and 7%, which is kind of what this model shows, it starts to put a little bit of fear into the market. And so it's tough because we've got some really big, tremendous disruptors right now happening worldwide. The lockdowns in China are probably exceeding now the impact from the war in Ukraine. And what we're seeing, we've seen supply chains now elongated. They're double the length of time that we had just a year ago to try and get a product out of China and trying to get it into the United States. So what was like a 39 to 40 day processing time between the time a product left a dock at a manufacturer in China to the time it hits a port in the US, that time now is almost 80 days. So, and then you've got to move it through the US domestic system. So there's still just tremendous disruption taking place in the global supply chain. Regions that account for 50% of China's total GDP still in partial or some full lockdown mode. 180 million people currently, exposed to that. And just in the last 24 hours, President Xi has kind of come out and said that the dynamic, he calls it dynamic zero COVID policy in China, is going to be long-standing. So even if they start to open a market back up, the minute they start to see rising COVID cases, they're just going to shut it right back down. So this whole situation has created a weird environment, I think, in the US. We've thrown a couple extra slides in here. So if we can go to the next slide, I want to talk real quick about just an anecdote. I've had a number of CEOs calling me, and they're looking at data like this. So this is business investment and spending. This is corporate executives that are investing in equipment and infrastructure. And in many of our models, you're going to see the result of this, like the machinery model right now. And machinery output is very, very strong. And you can see right now we are spending at an all-time record high. We're going to trend at about $80 billion in spending just by corporations this year, and trying to improve their output, trying to improve productivity, trying to automate their systems. It's 10% higher year over year, and it was already growing at a pretty substantial rate last year. So when we look at and peel back just the economic data alone, and if we were just to rely on current economic data, the market looks pretty good. The operating environment looks pretty good, except for all that inflationary pressure that is built. That's the one negative sign that we see. Consumer spending is still good. Again, as we show here, corporate spending is still good. We see just so many positive indicators. But again, as CEOs have told me, they're looking forward and they're concerned about what they see. And the IPMAN model is one of the few that I've seen that really is taking an analytical approach at trying to understand what that downturn might look like. And it's showing a lot of near-term pressure. So that's interesting. And then I think on our next slide, we have the long-term look at IPMAN.
Yeah, and there's not a whole lot that you can say about this thing that jumps out at you, other than when you take a look at that downturn that we've been talking about. You mentioned before, we haven't seen a downturn this steep, this fast, this deep since 2008 in that Great Recession. Now, we're not, thank God, we're not talking about something that far down, but it is deeper and steeper than what we experienced back in the 2018 to 2019 timeframe, which is, what it had kind of looked like before. It's a little bit deeper and steeper now. Yeah,
that's a perfect example of what we're talking about, because when we look at other data, and I'll show you a chart in a minute on recession probabilities. And right now, most recession probability charts are pretty low. They don't show recession in the next 12 months. What we're showing, at least in the models right now, and John, remind me, how accurate is IPMAN running right now when we tested, over 3-month and 6-month windows?
Yeah, the 3 and 6 months windows, we've been sitting still in between 97 and 98%. For general, I'd have to take a look at the back charts, but we're still well above 95, 96%. That's for sure.
And we're pretty hard on ourselves. I mean, we're pretty rigorous about how we measure that, and we're trying to be as accurate as we can.
And the measurement is that we're not trying to say how far we are out each month. Month to month, you can always be off a little bit, and then you do it the next month and you're correcting the previous month. Right. That's kind of a cheater's way to measure your accuracy. What we're measuring is we're saying, what was our prediction for today 6 months ago, and how close were we are then? And that's a pretty tough measure to go against.
It is, and I think we need to continue to put that strict measurement on us, because think about what we've been through over the last 2 or 3 months, and the model has held accuracy, incredible accuracy. And I don't want to overplay this and not try to play this up, but the implication is this: is that if we do trust what the model is showing us, if we trust it, which by now we've been doing this 2 years, we do trust it. I don't like the story it's telling us, because the story it's telling us is a pretty negative story. So that's the big warning. And again, if you go to the next chart, if we read current tea leaves that's available to us, so this is the Federal Reserve prediction on recession, and it uses a couple different treasury curves, and it compares the two treasury curves. And if you look over history, it's been very accurate. And right now it's showing less than a 3.7% chance of recession between now and the next 12 months. So the models are showing us a little more volatility, a little more fear, a little more trepidation. But I will say this: if you could this is going to be clunky, if you can go back one slide, again, look at our 20-year chart, you can see that, again, like you said, compared to the Great Recession, where it took the dip and then it just continued diving, right? And that's when we went into deep recession. We could see it dive all the way through. This one looks a little more like it's predicting a curve, a little more like the 2001 recession, where it was kind of short-lived. It was very quick, pretty shallow. And that's kind of what this is saying, is that maybe we only get a dip by definition, which is 2 consecutive quarters of negative contraction in GDP. But it's showing in 2023 a bit of a flattening and a little bit of a recovery there. So we'll continue to watch it. And again, right now there's so many black swans taking place around the world, with the war in Ukraine, what's happening in China, and then kind of ripple effects that are impacting other markets around the world.
Well, and that's one thing I wanted to kind of mention is you mentioned these black swans and thinking about the scenarios. Yeah, the models are looking ahead, but let's say even with we can't predict the pandemic or, how these COVID waves are coming through, but let's say Xi changes his mind and all of a sudden everything opens up. The model's going to swing one way or the other. And I mean, that's going to be a dramatic change. The world market's going to change. The same thing if the war in Ukraine, which you mentioned, if all of a sudden peace breaks out all over the world, well, things are going to change. So those, and I'm not saying that those are what's going to happen, but the impact of those things which we cannot predict, the people factors, are really going to have some impact on the way this model goes one way or the other.
Yeah, and you and I talked yesterday about wargaming a little bit and talking about on those 2 specific things. We can't really predict the Fed. We could go in and we could play around with interest rates a little bit and see what would happen if they went too aggressively. And we may do that, but the Fed's reacting to what happens around the world, and primarily just exactly as you said in those 2 areas, primarily the war in Ukraine, how it resolves and what that looks like from a sanction perspective. And then more specifically, probably more immediately, what happens in China. It's interesting because think about just the ending of lockdown restrictions in China. On one hand, it would be fantastic because the global supply chain would start moving again. On the other hand, some of the pressure that's putting downward pressure on this particular model is inflation, and inflation in like commodities and oil. Right now, you've got the world's 2nd biggest economy kind of locked down. So when it comes to oil consumption and oil demand and energy demand, diesel demand, all those factors right now, you got a big chunk of the global economy that's just not buying a lot at the moment. So if it were to come back online overnight, we would probably see petroleum prices surge. We'd probably see diesel prices again surge. We'd see them go from high inflationary levels right now to even higher inflationary pressures. And so you and I have talked about wargaming that out and using the model and trying to see what those scenarios look like. And so,
and we're going to need to, because if you think about the mixed economics, you've mentioned the different indicators right there. Oil goes up, but at the same time, another thing that's been putting pressure on the models has been manufacturing wholesaler inventories. Well, they're going to go down.
Right.
And so you got this mixed message. So going into and actually seeing what's going to happen on the models is going to be really fascinating when we get a chance to do it.
Yeah, and I think folks should watch for that. Hopefully over the next 30 to 45 days, we'll get those built and hopefully be able to war game that out and play it out a little bit. So
sure.
Yeah. So anyway, that's kind of where we are. We've talked a little bit about recession risk. We've shown you what the real data looks like. We told you what the model is showing. The model is showing a little more downward pressure, probably a little more in step with Wall Street and what Wall Street has been doing over the last couple of days, where there's a lot of fear right now in the market. But for now, each of those independent other 7 models that we have in the mix are showing, some different kinds of futures. A lot of them generally showing some of this near-term pressure, but a few of them are still showing acceleration. And I think that's going to be the story moving forward, is that there's going to be industries that are going to absolutely not even know that a slowdown is coming. They're going to blow right through it. Demand is so strong, they're going to struggle to meet that demand. But there are going to be some sectors that are going to start feeling it a lot more quickly. And we talk about those in the other 7 sectors. So we'll get to those.
Okay. Well, that concludes our look at industrial production, manufacturing specifically. And we hope to see you again next month.
Very good. Thanks, everybody. Take care.
Bye-bye.